My name's Lou Bilionis. I'm the Dean at the College of Law, and I'm here to welcome you to the Corporate Law Center Symposium for 2012. It's something we look forward to greatly every year. I've been thinking a bit about this symposium, looking forward to it, and it occurred to me that with all the attention on the health care bill that America has paid this past week, it's easy to forget that Congress, just a year and a half or so ago, passed the most comprehensive and far-reaching financial reform package since the 1930s. It's quite a feat to overshadow that kind of accomplishment. But we're not going to let that persist today. You've come to the right place to learn about the Dodd-Frank bill. Barbara Black, Professor Barbara Black, Charles Hartsock, Professor of Law here at the College of Law and Director of our Corporate Law Center, promises me that she and her fabulous panelists for the day are not going to march you line by line through all 16 titles of the Dodd-Frank bill. They'll only be going through every other line. No, in fact, it would be an impossible task to cover all of this bill in 6 hours, or for that matter, in 6 days or 60 days. But what you will see is a really well-conceived program that's going to focus on key themes that are going to drive what is obviously going to be a tremendously complex process of implementation, not only in agencies and departments, but not only there, but also in Congress and in political life in America and in your world as well. So you're in for a treat today. I'm very glad you're here. What I would suggest to you is that we've been waiting a little bit to start because we're told that the advance enrollment for this program today is quite large. Indeed, you might say it's too big to fail. And we've been giving some people a time to find parking here at UC and come. So expect that the seats beside you are going to become occupied before too long. Many of you know that I am a huge fan of Barbara Black, and I've told you before that it seems to me as Dean the greatest pleasure I have is to introduce to you terrific faculty members. She's certainly one of them. It's been a great day for Cincinnati when we brought Barbara Black here to direct this Corporate Law Center, and without further ado, put your hands together and welcome her, and thank her for putting together this wonderful program.
Dean Bilionis, thank you very much for those remarks, and thank you all for coming out. I really think this will be a really, really excellent program. And before we get started, I just want to say a lot of people have worked really hard to put this program together, and I just want to give a shout out to two people whose efforts have really been above and beyond the call of duty. That's Lori Strait, the executive assistant to the Corporate Law Center. Every one of you I know has had some contact with Lori. And without her work, this would not run anywhere near as efficiently as it does. And also I'd like to thank Marley Shippers. Marley will be graduating this year. She's class of 12 from the law school. She's one of my corporate law fellows. She's worked very hard in putting together the program materials. She's coordinated with the speakers. And again, I owe a tremendous amount to Marley. All right, so Dodd-Frank, that's what you came here to hear about, I guess. So it was signed into law July 21, 2011, so not quite 2 years. Its goals are lofty. According to the congressional summary that accompanied the bill, it is to create a sound economic foundation to grow jobs, protect consumers, rein in Wall Street and big bonuses, end bailouts and too big to fail, prevent another financial crisis. That's a tall order. Critical issues include systemic risk regulation, resolution authority, the Volcker Rule, over-the-counter derivatives, fiduciary standard, housing finance and securitization, and consumer financial protection. The Act requires federal regulators to engage, and I've seen a variety of numbers, anywhere from 230 to 400 rulemaking. So a lot of rulemaking. And to conduct at least 67 studies, often under very tight deadlines. So 20 months into implementation, where do we stand? That's what we're going to explore today. Implementation is behind schedule. Perhaps that surprises no one. Implementation has been controversial. Richard Cordray, many of you know as the former Attorney General for the state of Ohio, was appointed director of the Consumer Financial Protection Bureau as a recess appointment. Controversial proposed rules have led to extended periods of notice and comment. For example, the Volcker rule, about which we will hear much more later. The D.C. Circuit has already vacated one SEC rule authorized by Dodd-Frank, the proxy access rule. There is pending in the Federal District Court in D.C. A challenge to another agency rule, the CFTC's position limits rule. And there are calls for a repeal of Dodd-Frank. It has become, in fact, a campaign issue, with candidates citing it as a major impediment to economic growth. So clearly, we have much to talk about today. Let me just give you a little roadmap for the day. I really think we have a great mix of academic policymaking and practical viewpoints. This morning, there will be 2 panels by academic speakers on a variety of issues. Then we will break for lunch. We have a lunch speaker. I'm very pleased to say that Don Tuzlo, who's the executive director of the Financial Stability Oversight Council, will be speaking to us. He'll be talking about implementing Dodd-Frank, where concept meets reality, so that will probably be a good change of pace for our lunchtime considerations. So we have boxed lunches. I'm going to ask people to move rather quickly and pick up a boxed lunch and bring it back here so that we can continue. We can have our lunch speaker as you eat. Now, we are webcasting this, and it's being webcast live. And so for people who are watching it on the webcast, they may email questions at any time. We'll repeat the email address periodically throughout the program. This will be the first time I say it. Corporate Law Symposium, all one word, no spaces, at law.uc.edu. Okay, so and then after the lunch, there will be one more academic panel, and then we will conclude the day with a practitioners roundtable where we have a panel of experienced practitioners who are going to be addressing some of the cutting-edge issues relating to Dodd-Frank that I think are of particular interest to practitioners. All right, so with that, I'm now going to turn to my moderating role and bring us into the first panel. So, let's do that here. All right, so the first panel, we're dealing with aspects of regulatory failure. In the interest of time, I'm not going to summarize our panelists' biographies. Each of them has a long and distinguished record, and you can read it in the program, and I encourage you to do so. So I will simply at this time, I'll introduce each speaker before they speak. So each speaker is going to speak for about 20 minutes. I'll ask you to hold questions until the end, and then we will open it up for questions. So the first speaker is Professor Elizabeth F. Brown, Assistant Professor of Risk Management and Insurance at Georgia State University, J. Mack Robinson College of Business. Elizabeth?
Technology is wonderful when it works. Basically, as Barbara said, my name is Elizabeth Brown. I teach in the College of Business and the Department of Risk Management and Insurance. And what I'm here to talk about today is the Federal Insurance Office. Basically, prior to Dodd-Frank, there was no federal office governing insurance. And in fact, the Federal Insurance Office is not a regulator. But what I'm going to do today is basically talk about the problems that led the drafters of Dodd-Frank to feel that there was now a need to have an agency at the federal level looking at insurance and advising the rest of the federal government on it. So we'll look at the problems first, then we'll look at exactly what does Dodd-Frank do with regard to insurance. And then I was going to look at the report on insurance modernization that the Federal Insurance Office was supposed to have issued in January and still has not. Since they haven't, I can't actually comment on what's going to be in the report or what is in the report. I could comment on what I think is going to be in it based on who's making up the Federal Insurance Office and their advisors and the kind of lobbying that the industry has been doing with regard to that office. So basically, before the crisis even occurred, after the passage of Gramm-Leach-Bliley, banks started and securities firms started acquiring insurance companies, and insurance companies started acquiring banking and securities firms, and so you started having these financial conglomerates. And when the financial conglomerates started looking at how insurance was regulated, they had a lot of problems with it because insurance is regulated at the state level. There is no federal regulator for insurance, so each one of the 50 states regulates insurance. So if you want to sell a product, a new insurance product, say some kind of insurance product to protect the equity in your home, which is now currently being offered in Georgia and Oklahoma and a few other states, you have to get it licensed in all 50 states. And in order to be an insurance provider, you have to be licensed in every state that you want to offer the products in. So insurance regulation, if you wanted to be a national insurer, offer your products nationwide, was extremely time-consuming. It could take at least 2 years to get a new product approved by all 50 states. The regulations in the states were inconsistent, and as a result, each state might require you to meet different requirements in order to meet their consumer protection requirements or to meet their prudential standards. They often had, obviously there was lots of duplication because they were looking at the same issues in all 50 states. Is this going to be an unfair trade practice? Is this going to meet our consumer protection issues? It was expensive. And finally, it hindered the establishment of international norms. Basically, insurance as an international financial norm did not have an international body for it until relatively recently. Whereas the banking industry had the Basel Committee back in the 1970s, the International Association of Insurance Supervisors wasn't formed until the 1990s. And so and even once it was formed, getting it to come up with insurance norms was very, very difficult because there was no federal regulator to represent the US point of view. All 50 states are members of the International Insurance Association, and they have very different viewpoints. And if you don't have the United States helping make insurance regulations or setting norms, you've got a big problem because the United States was the largest single market in the world. Europe has now surpassed us within the last few years, but we're still the second largest market. Everybody else is much, much, much smaller. And so if the regulations are different in the United States, it's a huge problem for international insurance companies. Once the crisis, so before the crisis, after Gramm-Leach-Bliley, for 10 years, there were a number of different proposals floated to address the problems that the banks and the new insurance companies were looking at. One was to really push the National Association of Insurance Commissioners to promote uniform laws and reciprocity, so that there would be one standard and you wouldn't have all of this duplication, and once you got something approved one place, all of the other states would accept it. That's been a very slow, arduous process. It hasn't progressed as fast or as quickly as people would like, and as a result, there's still pressure from national insurance companies for some kind of uniform standards or some kind of federal intervention. A second option that was considered was have the federal government mandate uniform federal standards for insurance. And this was proposed through something called the SMART Act, which basically stood for the State Modernization and Regulation Transfer Act. It basically was smart. The SMART Act was an idea that that the federal government would mandate what the insurance laws had to be. That had some constitutional issues with it, some of the same kinds of constitutional issues that were being addressed earlier this week with regard to the with regard to the Medicaid portion of the Affordable Care Act, in that it mandated the state regulators spending monies on things without being given any money to do so by the federal government. The third alternative was to allow insurers to opt out by basically creating a dual charter system whereby instead of getting licensed by the states, you would simply get a license from the federal government, and that would allow you to operate in all 50 states. Now, that doesn't really get you uniform regulation. It basically has the federal government competing with the states as to which regulatory regime that you're going to get. You'll still have the 50 different states doing what they want to do. Once the financial crisis hit and AIG collapsed, or verged on collapse, basically a lot of people became concerned that insurance regulation at the state level had not worked well, and that it had created a lot of regulatory gaps, allowed for a lot of regulatory arbitrage, and that the states were not looking at managing systemic regulation. And all of this really stems from what happened with AIG. Now, the insurance regulators at the state levels basically response to that is, AIG was not our fault. AIG was not our fault. Yes, AIG is predominantly an insurance company, but it is a financial conglomerate. It had savings and loans, it had securities firms, and the portion of it that blew up, credit default swaps offered by its Financial Products Bureau in London, credit default swaps were not defined as insurance. They were originally created in the 1990s to hedge loans. They basically were a way of banks being able to offer something that was functionally equivalent to financial guarantee insurance. But because of the way they structured them, they were able to convince regulators at the state level that they were not insurance. So if you look at AIG as a financial conglomerate, the way it was regulated was something like this before Dodd-Frank. Except instead of having the Federal Reserve managing the holding company, because it didn't own a bank, it only owned a savings and loan, it was managed by the Office of Thrift Savings. Before Dodd-Frank, if you were a financial conglomerate like this, depending on what kind of depository institution you had, determined who was the consolidated regulator for your institution. If you owned a bank, it was the Federal Reserve. If you owned a savings and loan but no banks, it was the Office of Thrift Savings. If you owned an industrial loan company, which is the equivalent of a bank, but is only chartered in 7 states, you were not regulated by either the Office of Thrift Savings or by the Federal Reserve, but you could voluntarily be chosen to be regulated by the SEC. And so basically, you had to deal with this kind of mess. OTS was not originally designed to deal with an entity this complex, and it didn't have a very large staff, so it's not surprising that in dealing with a company that spanned the entire globe, that it had trouble dealing with figuring out its risks. Part of the reason that credit default swaps were not classified as insurance goes back to the way we regulate financial products. For many, many years after the Depression, products in the United States were siloed based on what kind of institution offered them. You had banking products, you had insurance products, you had securities products, and they were nice and discrete items. In the wake of deregulation that began in the 1970s, with securities firms beginning to offer money market accounts, which essentially are the same thing as a demand deposit account in a bank, but without the backing of the FDIC insurance, you start getting lots and lots of hybridization products. And so you go from these nice, neat silos to what looks to me more like this color wheel here, where you've got banking, insurance, and securities products. Yes, there are some products that are still very unique, but there are lots of products that have elements of all of the others. And when you come up with a new product, one of the things that the regulators have to do is decide who gets to regulate it. Are we going to regulate it based on whether it's a banking product? Are we going to regulate it based on whether it meets the definition of security? Is it closer to a security than it is to an insurance product? Or if it's an insurance product, do the insurance companies get to regulate it? Well, CDS's credit default swaps basically were created by investment banks to look and act like financial guarantee insurance, but instead of being paid off when the buyer actually lost money because the person to whom they had made a loan defaulted, all that was required was not that they had actually suffered a loss, but that the person had defaulted. And so you end up with this problem with definitions. Instead of defining them based on these narrow definitions of is this a banking product, is this a security product, is this an insurance product, I think what we really need to move to is something that looks more at a continuum where all financial products, regardless of what institution they're offered, either engaged in risk transference or they're engaged in investments, and some of them have elements of both. And rather than trying to place them narrowly in one of these boxes, we need to start regulating them based on this continuum. But we're still in the world of boxes. In the world of boxes, nobody wanted to regulate credit default swaps. At the federal level, the federal government basically prevented the Commodity Futures Trading Commission from regulating them with the Commodities Futures Modernization Act, and it also attempted to prevent states from regulating them under the state bucket shop laws and under their gambling laws. But the Commodities Futures Trading Commission Act did not prevent insurance laws from regulating them. And so the insurance commissioners could have decided to have regulated credit default swaps as insurance. New York was presented with this as a question, and they basically decided to hang their hat on the fact that since there was no indemnification of a loss, that this was not an insurance product. And then later, the New York legislature actually modified the insurance legislation so that they specifically excluded CDSs. Well, there are other ways of defining insurance that don't hinge on loss. In fact, some traditional insurance products that you're all aware of, like annuities, have nothing to do with losses. And in fact, before the New York State Attorney came out with that opinion, the National Association of Insurance Commissioners was making an attempt to create a broad definition of what would constitute an insurance product that would have brought in lots and lots of other derivatives, such as weather derivatives, within the realm of insurance. And so their definition focused on whether or not something was a transfer and distribution of risk in which a fee was paid, and that was evidence of insurance. The reason that the National Association of Insurance Commissioners was concerned about this, particularly with regard to weather derivatives, is that they are an easy substitute for property and casualty insurance. Rather than if Katrina hits, rather than having to prove to the insurance company, is this damage due to water, is this due to wind, or is this due to flood, in other words, all you had to do was show that Katrina hit, and under a weather derivative, you get paid off. So property and casualty insurers were beginning to lose business to people who were to banks and investment companies that were offering weather derivatives. And so they were trying to say, look, you should have to play by the same regulatory rules that we are. Let's get these classified as derivatives, these derivatives classified as insurance. NAC was not successful in selling that idea. Nevertheless, that idea of a much broader definition of insurance is still one that was resonating throughout the insurance commissioners. The current director of the Federal Insurance Office, Michael McGrath, was in 2006 the Illinois director of insurance, and when he was testifying before Congress, the definition of insurance that he used was as follows: that insurance was a risk transfer product that consumers buy in advance in exchange for a financial guarantee of future benefits when a specified event occurs. That definition would have included credit default swaps. It would have included all sorts of credit derivatives and other kinds of derivatives. If that definition had been the one that had been used rather than the one that fixated on loss, insurance credit derivatives, credit default swaps should have been regulated by the insurance industry and the insurance regulators. These definitions, however, have to be agreed upon internationally. Something like a credit default swap, it's too easy to simply have it written offshore. Lots of products, hybrid products that were concerned about being classified as insurance and subject to that very time-consuming, expensive state regulatory process were initially offered overseas rather than in the United States until they could be assured that the insurance regulators in the United States would not classify them as insurance. In 1997, before the Commodities Futures Modernization Act, before the New York Attorney General opinion, the International Securities and Derivatives Association had Mr. Robin Potts, who's Queen's Counsel, draft a private opinion arguing that CDSs were not insurance, and in his opinion, he also fixated on the fact that there was no condition for a buyer suffering a loss. And they used that to persuade the UK government that they should not regulate CDSs as insurance. So it's certainly probable that in the back of the New York regulator's mind was, if we classify this insurance, all that will do is move the market to London. So one of the reasons that you need to have international norms is this problem that it's too easy for many of these products to just pick up and move across borders if the regulation in one geographic area is too stringent. By the way, a representative from the International Securities and Derivatives Association said that without that Potts opinion, the credit default swap market would never have been created. And I wanted to point this out to you. The top line is the notional amount. Frequently you'll see in press reports what the notional amount is. That involves a lot of double counting. When you start actually doing the actual transactions, it's a much lower number. It's still trillions of dollars, but it's not $45 trillion. So what did Dodd-Frank do to address these problems? Well, it did a number of things. It established the Federal Reserve to be the supervisor for all important, systemically important financial institutions, or SIFIs, and allow the Financial Stability Oversight Council to designate non-bank institutions as SIFIs. It allowed the Treasury Secretary and the U.S. Trade Representative to negotiate international agreements on insurance prudential standards that would preempt state laws. So we now have at the federal level, the first time, an ability for the federal government to, through international agreements, establish national prudential standards for insurance. It mandated certain standards for non-admitted insurers and reinsurance, so there are now, at the federal level, federal laws that mandate what the insurance standards for those particular areas of insurance are. And it created the Federal Insurance Office to coordinate and advise Congress and the federal agencies on insurance issues. Now, so this is what we have after Dodd-Frank, if you're a financial conglomerate. It's not a lot better. You got rid of the OTS, and in place of the OTS, you have the Consumer Financial Protection Bureau. It does not have the power to regulate insurance products. That was specifically carved out. That still has to be done solely at the state level. Consumer protection for insurance products is still solely at the state level. You have the Financial Stability Oversight Council with its 15 members, only 10 of which can vote, and the only one that can vote that's an insurance expert to be appointed by the president. The Federal Insurance Office Director cannot vote. So what is the Federal Insurance Office's function? It's not a regulator. Congress specifically did not set it up as a regulator. It doesn't participate. It basically is to provide information to the federal government and to the federal government agencies about insurance. So it monitors the insurance industry for gaps that might pose systemic risks. It's to monitor how well the insurance industry is meeting underserved communities. In other words, basically trying to do for the insurance industry what the banking industry has with the community, with the various banking laws that protect underserved communities. It's to recommend to the Financial Stability Oversight Council who should be classified as a systemically important financial institution. It's to assist the Treasury Department in administering the Terrorism Risk Insurance Act. It's to coordinate for federal participation in international insurance negotiations. It does not replace the 50 state insurance regulators that go to the International Association of Insurance Supervisors. It does not replace the National Association of Insurance Commissioners who participate in that as well. So you've got a federal body added to those 51 representatives from the United States, but it does not have the power to dictate to those states what they are required to do or positions are required to take in these international negotiations. If the Treasury Secretary and the USTR actually do negotiate an agreement on international prudential standards, it's to determine to what extent those standards preempt state law. And then it was finally to prepare a report on how to modernize insurance regulation. So it doesn't have any regulatory authority, at least not yet. With regard to the international negotiations, as I said, it has a seat at the table, but that's it. The Treasury Secretary is the one who's required to do the negotiations. So in terms of that last thing that it's supposed to issue, that report on modernization of insurance regulation, the states are very concerned, and the National Association of Insurance Commissioners was very concerned that it would recommend that they federalize some or all aspects of insurance. I think that's highly unlikely. Why is it highly unlikely? Because Michael McRae is a former Illinois insurance commissioner. In his past testimony before Congress, he was very strongly supportive of how well state insurance regulators operated. He strikes me as unlikely to have suddenly flipped and changed his mind on that, having changed his hat. In addition, the advisory committee for him, the Federal Advisory Committee on Insurance, its 15 members are comprised predominantly of other state insurance regulators or industry specialists. There's one consumer person on the board and one academic. The academic, his writings indicate a very conservative approach that at best would recommend incremental changes at the federal level. There's certainly not going to be the adoption of, say, a federal optional charter coming out of this report. I would be highly surprised. When they issued a notice and requested comments for it, they only got 147. Compare that to the 17,000 that have been issued that have been made for the Volcker Rule. And the people who have commented on the modernization of insurance regulation have again predominantly been industry officials who are not, and most of them oppose federal regulation. As one of my colleagues who's an attorney said, they've come to realize that they might prefer 50 little monkeys rather than one giant 800-pound gorilla. And insurance spends a lot on lobbying. It spends more on lobbying than any other segment of the financial services industry. 1/3 of financial service regulation lobbying is by the insurance industry, and that's been pretty consistent over the last decade. So I would suspect that the financial modernization report will at best be recommending incremental changes. It will not be radical, and it will not be far-reaching. Thank you.
Thank you. Thank you, Elizabeth. All right, our next speaker is Professor Tamar Frankel, who is a professor of law at the Boston University School of Law.
I don't have pictures. Oh. And I'll be even more.
I want to turn this off.
Sure. I'll start from, I want to simplify things. I'm too complicated. So I want to know, first of all, what is the financial system for? And on a very, very basic level, it is really the transfer of money from savers to borrowers, in the assumption that the borrowers will either consume or will produce, and if they consume, they also drive production. And that's really what the financial system is about. Okay, therefore, what is the transaction? I give money, if I'm the saver, what do I get in response? I get a promise. I get a promise that I'll get the money plus something. And so I, with all due respect, including myself, I don't talk about financial intermediation as products. There's promises, the same P, but different. They are promises. So what we should remember, and I try not to change it, because then if it becomes product, it becomes assets, these are promises. That's all they are. Okay, so we are now dealing in a market with promises, for promises. All right. So now we encourage these, and because we encourage this interaction, we have intermediaries. And the intermediaries are, in my opinion, used to be and are today of two kinds. One is institutions, like banks, who borrow my money when I put them in their accounts and then lend them. The other one is markets. The institutional intermediation, and please forgive me, I'm talking about basics because I'm too confused. I can't see all of that unless I know what I'm talking about. Okay. So I have, if I have institutions, why can't I have markets about everything? The answer is that in order to have markets, you need standardized documents. And therefore, I, as the borrower, must take exactly what the lender gives me or what the saver gives me. But the saver, I want to put my money for 2 days, 1 day, 1 minute, but the borrower needs the money for 30 years. That is when the institution comes into play. And therefore, I can put my money and get in 1 day or in 1 minute. But the institution can turn around and then give the money for 30 days. Oh, I'm sorry, 30 years. Okay, so we have institutions when there are standardized obligations or promises. I can then give 100,000 such promises. That is when I issue what we call securities. Or in order to give liquidity to the savers, after all, if the money goes to build a factory, they can't come and take it back. So we have a secondary market. Everybody knows about that. We have then 2 types of intermediaries. We have the market intermediaries, and we have the institutional intermediaries. And that is how we used to have it in the past. Fine. In 1930s, when Congress established that, the market almost didn't exist. And the focus was on institutions. And by the way, insurance was excluded because insurance had its own disaster in the 1920s at the beginning. And the regulation was so strict after that that Congress said, unless the federal law explicitly applies to insurance, we don't need to deal with that. And that has been the law ever since, even though they left it to the states. So that was the design. What did Congress do then? It established on institutional intermediation substantive regulation. You're going to do it this way, you're going to have this backup, you're going to have this, that, and the other. And in the market, the regulation was disclosure. The assumption was that you're dealing with contract. So if you want to buy a promise, you can sell a promise. And that's the end of the story, except for one thing. If you want to sell to 100,000 people, then caveat emptor doesn't work that well. They can't ask the questions, they can't. And so instead of that, you have the government. The disclosure that we call now disclosure is really caveat emptor for the market as a whole. And that is the way we had it. Even in the 50s, we started having what was called here hybrids, and I will call them hybrids. I must admit, my doctoral thesis was on variable annuities. I won't tell you when, but nobody knew how to spell it then. And so I thought I was doing securities. No, I was doing, in fact, insurance on the one hand, because a piece of the insurance industry, or not industry, but the insurance company was this mutual fund inside it that was regulated by Investment Company Act. So you had a hybrid of securities regulation, insurance regulation, and the Investment Company Act of 1940. So that is the beginning. what you saw afterwards in the 70s, and it started earlier, is another type of this hybrid. Now I'm talking institutional, what we call SPVs or SPEs, and that's special entities. What they do is they convert the the promises that are not standardized into standardized promises. They take loans and they issue standardized obligations or promises that can be then traded in the market. These are also hybrids because they are really mutual funds. And here I bring in what a mistake a hybrid can bring about. After many exemptions, the SEC gave an exemption to SPVs and said, you don't have to be regulated under the Investment Company Act. And the rule gave conditions, about 3-4 pages of conditions. One condition it forgot. Now, at that time, there was no requirement for that. There is a section in the Investment Company Act, section 12D-1, which said you can't have a fund of a fund of a fund of a fund. You can't take the shares of one fund, put them in another box, and issue securities, and then take part of the shares of that second fund, put it in another box, and issue securities. What it really does, and what was done in the 20s, that's no surprise. It was done in the 20s, is first of all create an awful lot of promises of promises of promises of promises. And traders liked it. Not the traders themselves, those who paid, but those who were paid to intermediate. So you had a tremendous amount of securities that were based on very little real assets. Now, what has happened in the 70s is similar. You took an SPV, you divide it into 4, we became French, tranches. And then, tranche 1 got paid, whatever was left went to tranche B, tranche C, and tranche E, whatever. Then you took the last one, you moved those promises into another box, and again, you had tranches. You took that last tranche and you made it into AAA, AA, and whatever. But you don't have to stop here. You can take that and put it into another box and do precisely the same thing. Many of the disasters that we had in 2008 stemmed from an enormous amount of these tranches of tranches of tranches. Now, this again is a hybrid. It takes and it converts one type of non-tradable promises into another. So my subject was supposed to be disclosure. How do I come back to my subject now? Well, the answer is that when you look at what was imagined in 1930 for disclosure, was a fairly simple, not so simple, but understandable terms of the promises. When you look at what has happened in the 70s, No one, it isn't even a question of disclosure, no one knew what the basis for these SPVs was when they were one after another. There's a bankruptcy case in which a bank appeared and had a note and wanted to get paid on the note. And it transpired, it was asked, okay, you hold the note. Who is the owner? They had no idea who the owner was because they sold it to Freddie Mac, and Freddie Mac sold it to whoever they sold it to. So you lost in this process the promiser. You had pieces of promising all around. Disclosure doesn't work in this kind of, I'm not talking about complication. I'm talking about not knowing what you hold, who promised. And so the answer is that there are now too many of these hybrid situations in which no disclosure helps. But I will add one more thing. What we have done is we have moved a lot of institutional intermediation into marketable intermediation. So we heard, and it was wonderfully presented, that insurance has become marketable, but without the substantive regulation of backup. That's precisely what we described here. But there is continuous argument what it is, because if it is market, then all I have to do is tell you what it is. And if you don't understand, I don't understand, too bad. Okay. So the second part of my worries about disclosure is about the intermediaries themselves. When mutual funds were established, they were regulated as fiduciaries. That means people who hold other people's money for other people's sole benefit. Simple. And to that, you have also advisors who do the same thing. There was a question then in 1930 or 40, what about brokers who say, trust me, this is the best thing you could ever get? The decision was to separate and to say, if the broker doesn't get paid for advice, then the broker is not an investment advisor and is not a fiduciary and can act for his or her own benefit. Fine. The trouble is that with the change, brokerage has become, with the change into the market, brokerage has become a very important part of the intermediation. And in addition, brokerage has kind of intruded into real financial planning, a variety of other advice. The issue is simple. If we are talking about promises, I told, and I'll tell it again, when a salesperson looks at me in my dress and says, oh, it looks beautiful, I look in the mirror and I see, I'm like that, and so on. I know I can judge. But when you look at what is offered, it is so complicated that even experts sometimes are experts only in a piece of what is offered and not in all. So to say I give you disclosure is not effective. I will not do it to you, but I will do it to people who read my paper, because I have 2 pages, not of disclosure, but of exclusions from the disclosure that are now, I was very tempted to take half an hour and read to you all the exclusions. So the disclosure has become complicated not only because of the subject matter, but because of the fact that disclosure is backed by punishment of the law. The moment you have that and you have us lawyers come into the scene, then the issue is how do we reduce the risk. And the drive into specificity has brought about an incomprehensible disclosure. So now you have brokers, underwriters, the market intermediaries who have a combined sales stock which is not amenable to change, to check with, trust me, I give you the best thing. There's one issue that has arisen now, apart from others, in the area of pension funds. We are going to have an awful lot of pensioners, people who are now retiring, and there are millions of them. What has happened is that they are being called by brokers who give them advice on the telephone and induce them to transfer their savings into wherever the brokers get really more. Sometimes it's good, sometimes it's far from good, because the cost of all of this is borne by the savers, no matter what. Now, that is clear. So, this is number one. The Dodd-Frank Act has done something similar for the market and said to the SEC, please impose on brokers who advise individuals and their businesses in personalized advice, impose upon them the fiduciary duties of advisors. But of course, how you do it, we leave to you. Well, there's a tremendous amount of conflicting opinions. The SEC has not come up with any rule, not yet. It has held hearings, and FINRA has, the organization of the brokers have had hearings and so on. It is a continuous fight. I don't see the end of it. The Labor Department, looking at the numbers, became very concerned, and they also tried to come up with a rule. The rule they had was in 1975, 1 year after ERISA was passed in 74, and therefore they thought that it was time to maybe change it a little bit, and they did. And the result was, am I done? Okay. The result was to propose a rule. The answer is enormous resistance. You can't imagine. And the question is, how do you distinguish sales talk from advice? You can focus on what is offered if you have a mirror. But if you don't have a mirror, where do you go? You must then go to the advisor themselves. And when you go there, some of them really care for their clients, and unfortunately, some of them don't. And the point is they look at what they are being paid. And if you think that it is easy to find out how much they are being paid, I've got news for you. It is very complicated, and because it goes to mutual funds and Rule 12b-1, and don't ask. So I therefore, I don't have a solution, but I have a humble suggestion. I think the time has come for those who are intermediaries in the marketplace to give information and disclose not what they're selling, but who they are. And you don't need for that 2, 3, 5 pages. You need to have truthful. Where do I get my money? Truthful. Do I sell or buy the same thing? Truthful. That's really all. I love you, I don't love you. I can do without it.
Right.
Thank you, Tamar. Our final panelist is Arthur E. Wilmarth, Jr. He's a professor of law and executive director, C. Leaf, at George Washington University Law School.
Thank you very much. It's a pleasure to be here. I'd like to thank the University of Cincinnati College of Law for inviting me, and Professor Black for inviting me to participate. Certainly a very timely and important panel. The last, I would say 3-4 years, most of my work has been on trying to do what I would call a forensic examination of the financial crisis. What led us to this terrible result? And of course, what led us to enact Dodd-Frank. Certainly, my early work, I focused on what I thought were the major private players. The major private players were approximately 18 large global financial conglomerates, enormous institutions, of which about 8 or 9 were in the United States and about 8 or 9 were abroad. But of course, these are true multinational financial institutions that their home jurisdiction is somewhat incidental. They're doing enormous amounts of business across borders. I think Professor Levin will be telling us more about that later on in terms of how you might resolve one of these enormous institutions. But they are at the center of the complex financial instruments that certainly Professor Frankel talked about, the credit default swaps that Professor Brown talked about. They created this enormous complexity and what I would call a pyramid of risk that we have experienced. Interestingly, when I went back and looked, about 13 of those 18 institutions were implicated in one way or the other with Enron, WorldCom, the Wall Street research analyst, mutual fund late trading scandals but of the early 2000s. So it wasn't as if we didn't know that there was something troubling about this business model. This business model, which contains all sorts of financial services, is riddled with conflicts of interest. And I think what Professor Frankel was telling us is that when you are selling, marketing, trading in what you're also advising customers to buy, there's obviously a huge conflict of interest. What the Supreme Court and what the legislative history of the Glass-Steagall Act called a salesman's stake. If you have a salesman's stake in what you're advising people to buy, there's inherently a problem with that. So certainly the private actors, the big financial conglomerates, were a huge part of this problem. But then there were public actors too, because the more I looked at it, the more I kept looking at one example of regulatory failure, regulatory laxity, regulatory refusal to take any effective action after the other. And at some point you decide this is not a matter of inadvertence. This is not a matter of not knowing. Both the private actors and the public actors will tell you repeatedly, we did not see this coming. We didn't know it was coming. No one could have seen it. It was a perfect storm. But you know, when you have about 5 perfect storms in about 10 years, you begin to, you know, how many 100-year storms can you have in 10 years? It's a little problematic. So when you look at it, it becomes even more problematic. The most recent failures actually date back to 1991, which was the end of the last major financial crisis. We had an enormous financial crisis in the 1980s. Nearly 3,000 banks and savings and loans failed, mostly due to high-risk, both residential and commercial lending policies. So anyone who said, oh, we couldn't see that there might be a big problem with risky lending in real estate, I mean, one only has to go back, 20 years to see that that's exactly what we went through before. So this was nothing new. The taxpayers shelled out $150 billion to resolve the failed institutions. And Congress said, never again will this happen. Never again will we allow this to happen. And they passed this statute in 1991. One of the things that statute required was for the federal banking agencies to adopt uniform interagency regulations establishing binding standards to prevent unsafe and unsound real estate lending. One would think that was a pretty clear command. When the regulations actually came out at the end of 1992, after great struggle, what they actually did was set up guidelines, suggested guidelines as to how institutions ought to engage in real estate lending. And the guidelines were very weak. And the FDIC, to its credit, actually pushed for hard, tough regulations because it actually had a deposit insurance fund to protect, and it saw that deposit insurance fund wiped out in the 1980s. The other regulators thought about the institutions they were regulating. And they said, oh, we can't cut off credit. You know, people need credit. We need to get credit to them. And so what we got were weak guidelines. And this was a repetitive situation. So between 1999 and 2007, as many examples of predatory lending began to emerge, systematic predatory lending, abuse of unsophisticated borrowers began to emerge. Regulators kept responding with more and more weak guidance. Oh, you should try to make sure that people can repay their loans. Oh, yes, you should document what their ability to repay might be. But of course, with a wink, wink, nod, nod, these are not enforceable regulations. If you don't follow them, you won't really be sanctioned. And of course, so the institutions paid little or no attention. Look what happened. Domestic private sector debt in this country absolutely exploded between 1991 and 2007. When I looked at the numbers a few years ago, I couldn't believe it. Domestic private sector debt went from $10 trillion at the end of 1991 to $40 trillion at the end of 2007. Household debt went from 4 to 14 trillion. Financial sector debt went from 3 to 16 trillion. Corporate debt went from 6 to 10. Domestic private sector debt went from 150% of GDP to 300% of GDP. I mean, anyone looking at these data, and this is all reported in the Federal Reserve flow of funds, the regulators had to be seeing it. What were they thinking? I mean, this was setting up in a massive Ponzi scheme that was doomed to fail. In fact, the only credit bubble we've seen that was equivalent was in the 1920s. We know what that led to, the Great Depression. I mean, this is completely predictable. They had to be watching it. Why didn't they do anything? Well, it just so happens that actually private sector incomes and wages were completely stagnant during that period. So how are you going to actually increase consumption? People were not earning more money on an inflation-adjusted basis unless you were in the top maybe 5% to 10%. So how are you going to expand consumption? You expand credit to people. But that's an unsustainable issue. The numbers are really hard to come by, but my best calculation is that by the end of 2007, financial conglomerates had created about $9 trillion of risky debt just in the United States. If you add up all the mortgage debt, the credit card debt, the commercial real estate debt, corporate leverage loan debt, about $9 trillion. But that wasn't the worst of it. Through all the complicated instruments that Professor Brown and Professor Frankel told you about, the credit default swaps, the collateralized debt obligations, the tranching of tranching, there was at least $25 trillion of claims, debt claims outstanding with regard to that $9 trillion of risky debt. And I may be underestimating. But so what happened was when the housing boom stopped, right, when the Ponzi game ended, and housing began to blow up and people began to default, it wasn't just the mortgages that defaulted. It was this whole inverted pyramid of risky debt on top of it. All the credit default swaps, all the collateralized debt obligations that defaulted on top of it. So you had multiple defaults for each defaulting mortgage. And then, of course, that wasn't all of it either, because these instruments through securitization had been spread around the world. So the U.S. housing crisis became a global financial crisis. And that wasn't all of it either, because many of the same conglomerates were doing exactly the same thing in the UK, the United Kingdom, Ireland, Spain, Portugal, Italy, all over Eastern Europe. The same MO. GE Capital was making billions of subprime home loans in Eastern Europe, for example. So you had the same MO, the same modus operandi being followed in Europe, and so that's why Europe is in such horrible trouble, because they had much the same kind of risky lending spree that we had, but they probably even had less effective regulation than we had, which is pretty sad to say, because ours was terrible. What's the result? Okay, when all these big conglomerates got into trouble, they had to be bailed out. 12 of the 18 largest conglomerates got some kind of bailout assistance, either from U.S. or European authorities. Even in this country alone, we provided almost $300 billion of capital to the 19 biggest bank holding companies, and they were allowed to issue $235 billion of very low-cost debt through the FDIC. The Fed provided more than $1.5 trillion of liquidity assistance to U.S. and European institutions. So we, after allowing them to go on this incredible lending spree and marketing of high-risk, complex securities, we stepped in and bailed them out. Again, what were the regulators doing all this time? Well, the Fed actually had authority under a 1994 statute to issue binding regulations to stop abusive and predatory mortgage lending. They were repeatedly begged to do so by consumer advocates, by independent experts. From 1999 on through 2004, repeatedly they were told, you've got to stop this from happening. Chairman Greenspan said, I believe in the market. I believe that institutions won't make loans that can't be repaid. That doesn't make any sense to me, he said. Of course, later on he said, well, I couldn't believe that these executives and these traders were so short-term in their focus. And it was sort of like, well, my eyes were open. The problem was that was the second time he gave that speech. He actually gave exactly the same speech in 2003, I think it was, or 2, after Enron WorldCom. He said, I couldn't believe that infectious greed took over these institutions. Well, you get to make that speech once. You don't get to make it twice. Obviously, Enron and WorldCom and the disasters that happened then, which destroyed how many pension funds, didn't change his mind. And in fact, what's really true is that if you read his testimony in 2002, 3, and 4, after the blow-up of the dot-com telecom bust, he said to Congress, look, I'm cutting interest rates down to 1%. And this is actually priming activity in the mortgage markets. And we are allowing innovative mortgage instruments to be used to get credit to people and to allow home equity extraction, he says. And the rise in housing prices and the increased extraction of home equity is funding consumption, and we are thereby, counteracting this terrible recession we encountered after the dot-com WorldCom bust in 2001 and Enron and WorldCom in 2002. So he knew exactly what he was doing. He was basically using the housing market to try to offset what had happened to the stock market. Well, now we've crashed the housing market also. But for the Fed to say that they didn't know, they couldn't see it, it's just ridiculous. They absolutely saw it. The National Bank and Federal Thrift regulators were no better. They preempted all the states that tried to stop this kind of lending, and they gave their institutions carte blanche to do what they liked. Massive conflicts of interest. The OCC, the National Bank Regulator, the OTS, the Federal Thrift Regulator, which now, fortunately, has been given a decent funeral by Dodd-Frank and is out of business. These regulators were funded completely by the institutions they regulate. Not surprisingly, they viewed those institutions as constituents whom they should please. The Fed has a very interesting structure. The banks in each Federal Reserve District, there are 12 Federal Reserve Districts, the banks actually elect 2/3 of the directors of each Federal Reserve Bank. The last third of the directors are called public interest directors. But it was very interesting. The public interest directors often turned out to be large securities firm people, maybe insurance company people, or big clients of the biggest banks. And so the public interest directors were usually not people like consumer advocates or labor union people or ordinary citizens. They were the big, either big financiers themselves or big clients of financiers. Let me just give you an interesting example with the Federal Reserve Bank of New York, which is known as Wall Street's banker. That should tell you something. If you're Wall Street's banker, how independent are you? So people who served on the Federal Reserve Bank of New York, their board of directors turn out to be people like Dick Fuld, the chairman of Lehman Brothers. Of course, he leaves just before Lehman fails. I guess that was a sign that Lehman wasn't going to survive. Jeffrey Immelt, the head of GE, who got massive amounts of help, even though they weren't a bank. And then most interestingly, Stephen Friedman. Stephen Friedman was the former chairman of Goldman Sachs. He was still a director of Goldman Sachs. He was a public interest director on the New York Federal Reserve Board. Well, in the midst of the crisis, Goldman Sachs is is forced to convert into a bank holding company in order that they would be more securely under the Fed's protective umbrella. That was the whole idea. So Goldman becomes actually a regulated bank holding company, no longer an independent securities firm. And that's a problem, because if you're a Class C director on a Federal Reserve Bank, you may not own any bank stock. Well, Friedman owned some 46,000 shares of Goldman stock, which was now a bank stock. No problem. The Federal Reserve says, oh, we'll give you a waiver so you can keep serving, although it was very quietly said. So he keeps serving. Well, that was such a good idea, he decides to buy 37,000 more shares of Goldman stock at the very time when he knows that Goldman is getting massive amounts of liquidity assistance and other help from the Federal Reserve, and he's obviously involved in the discussions. When later he is asked, why did you buy more stock when you knew what was going on? Well, we wanted to, as directors, we wanted to show that we were confident in the future of Goldman. So, well, finally this got out. It became public. This was very embarrassing. But in the midst of this, when he's under criticism, Timothy Geithner, who is then president of the Federal Reserve Bank of New York, is nominated to become Secretary of the Treasury. They've got to replace Timothy Geithner. Okay, who's appointed as head of the search committee to find the new president? Well, Stephen Friedman. Hey, let's make him the head of the search committee. He's so knowledgeable. And whom does the search committee choose to be the new president of the Federal Reserve Bank of New York? William Dudley, who just happened to have been the former chief economist of Goldman. And then finally, when all this came out, The public outcry was too much, and Stephen Friedman stepped down. But this is just a vignette. This is just a little insight into how the Federal Reserve System has been run. So interestingly, studies have since shown that if you served as a director on a Federal Reserve Bank, your bank was much more likely to get capital assistance, so-called TARP assistance during the crisis. And in fact, if you served on the Federal Reserve Board and you were a member of, and you were a director or officer of a bank, your bank stock immediately went up in value because the market would say, hey, now we've got a guy on the inside, right? They're going to get extra help. So these are very troubling things. I think the Stephen Friedman story is an example of the revolving door, that there's been a continuous interchange of senior regulators between, they serve as regulators, and then they go back either to Wall Street or to service providers of Wall Street, big accounting firms, big law firms that deal with Wall Street. And then they may come back. This has been a repetitive issue. The political clout of these institutions is undeniable. The financial sector has been the biggest political spender in terms of campaign contributions and lobbying at least since 1998. They spent $5.1 billion on lobbying and campaign contributions between 1998 and 2008. The financial sector accounted for 15% of all lobbying expenditures for all industry sectors between 1999 and 2006. The financial sector employed nearly 3,000 registered lobbyists in 2007. In 2008, 2009, the six largest banks, Bank of America, J.P. Morgan Chase, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, employed more than 240 lobbyists who previously worked in the executive branch or Congress. No wonder these guys are so persuasive, right? An IMF study found that those who spent the most on lobbying and political expenditures also happened to be those who were involved in the most risky activities. From 1994 until 2005, the financial sector had an unbroken series of victories in the in Congress. One big bill after the other got passed that they wanted. They also prevented any anti-predatory lending bill, any other bill that they didn't like from getting enacted. They didn't prevent Dodd-Frank from getting enacted, but they weakened several of the main provisions of Dodd-Frank. And they've mounted a very successful campaign since then against the implementation of Dodd-Frank. So the Volcker Rule, which you'll hear more about, I think, has been completely bottled up by determined lobbying. The Consumer Financial Protection Bureau, which was the thing they wanted least, right? Because horrors. You'd actually have an agency devoted to protecting consumers with real power to protect consumers, instead of leaving it to the regulators who felt that, oh, consumer protection is inconsistent with bank profitability. I mean, what an amazing concept that banks can only profit by shafting consumers. I mean, where did that idea come from? That became the rallying cry against the Consumer Financial Protection Bureau, was that consumer protection was inconsistent with safe and sound and profitable banking, and therefore you could never let a consumer protection agency be independent of the so-called prudential regulators who did very little prudential stuff during the run-up to the crisis. They fought that harder than anything, and of course, those of you know, they blocked any confirmation of the director until finally the president put in Director Cordray by recess appointment, which raises its own set of legal issues, so that the Consumer Financial Protection Bureau operates with something of a cloud over its head. And the Republicans have certainly said that the first thing they want to repeal Dodd-Frank completely, but the first thing they will repeal on Dodd-Frank is the Consumer Financial Protection Bureau. So the last 20 years have not been edifying. There has been a complete failure of regulatory effectiveness with regard to these enormously large and influential political conglomerates. Unless things change, we are set up for a repeat of what we've been through. Dodd-Frank makes some positive changes, but most of the changes rely on regulatory implementation and effective enforcement. And I'm unfortunately somewhat pessimistic as to whether we're going to see that. At least I think that the battle is still, or that issue is still very much an open question. So I think that, as Santayana said, those who don't learn from history are condemned to repeat it. We essentially repeated the crisis of the 1980s. We have repeated Enron WorldCom. Let's hope we don't repeat it a third time. Thank you very much.
Thank you, Arthur. All right, so we've had 3 stimulating, provocative presentations. We're going to open it up to questions. I want to repeat the email address for those listening on the webcast. It's Corporate Law Symposium, no spaces, at law.uc.edu. So we're open for questions. I'll just say, ask your question. I'm going to have to repeat it before it's answered so that we can get it on the webcast, but don't let that stop you. Yeah, right down here.
Great presentations. Thank you very much. Wonderful. I'm Arthur Frankel. I'm an attorney for one of those financial conglomerates. But one of my observations is that in the banking business, you get tremendous stress on the system when you have a very low interest rate environment and a very high interest rate environment. When you have those two extremes, there's tremendous pressure on the business. So in the 1980s, when we had double-digit inflation and banks were paying on their deposits 18% interest, that put huge pressure on banks, and they got into risky lending practices in the commercial because there was no margin that they could collect. So you had, the 3,000 savings and loan banks going under. Huge crisis. One thing there was that the Federal Home Loan Bank Board regulated thrifts at the time, and but they also made loans to those thrifts through the Federal Home Loan Bank system. And they separated that out, and they created the OTS, which Dodd-Frank took away. So they separated the regulation from the lending to those banks. And Professor, you made the point about the Federal Reserve, having members on its board, Dick Fowler, Jeff Immelt, and that gang. And, I think that the Fed should be separated. I mean, you should separate the lending function, which makes loans to the banks, where it might be appropriate to have directors of these institutions serving on the board, versus the regulatory function. And I do think there will be a repeat, because, I mean, you look at the nature of how this works, it's very difficult politically to separate that stuff out.
Okay, so the comment and the question was about the stresses that are put on lending institutions because of changes in interest rates, high interest rates, high and low interest rates. And the question relates to the feasibility or the appropriateness of separating lending from the regulatory function. Arthur, that sounds like it's a question for you.
I'll say a few words. I think Elizabeth might have something to add too, because she's looked at the UK. Yes, I think that that to me is the need for strong regulation. There's no question that when you have a very low interest rate arena, which we certainly had leading up to the financial crisis, people start searching for yield. And a lot of the reasons that these complex securities were created was that, first of all, Wall Street could corrupt the credit ratings agencies to put AAA on them, and they were providing 150, 200 basis points higher yield than any other AAAs you could find anywhere else. So there was an insatiable desire for these things. Well, it seems to me that the only people who can say no to that, right, are the regulators, because the market's not going to say no. The market says we want higher yielding investments, higher yielding instruments, and unless the regulators say no, we know that these instruments are either inherently too risky, or we're going to require enormously larger capitalization or margin or something to back them up. and we're certainly not going to allow you to do credit default swaps to back them up with no reserves. I mean, unless the regulators step in and say, no, the market won't stop. And so I think you're right. I mean, that the institutions, to some extent, you know, were following market pressures, and there was certainly a devil take the hindmost attitude. You know, if I don't do this business, the guy down the street does this business, so why should I stop myself? You know, the famous Chuck Prince comment that, hey, when the music is playing, you have to get up and dance, even if you know that eventually everybody's going to collapse and be dead at the end of the dance. You know, you got to get up and dance. And at one point, apparently, Prince actually went to Paulson, Hank Paulson, and said, you have to stop us from doing this because we cannot stop ourselves. Well, I mean, there was a certain degree of honesty in that, but I mean, what were the regulators thinking all that time? The interesting of separating lender of last resort from regulation is a very interesting one. I think that there's a lot to be said in favor of it, although in the UK, where they actually did separate lender of last resort from regulation, they ran into big problems because then the Bank of England wasn't talking very closely to the Financial Supervisory Authority, and they, you know, Northern Rock fell between the stools, and then everything got out of control. So, yeah, you're right. I mean, the combination of regulation and lender of last resort is very problematic, but we haven't been able to find a good solution. I know Elizabeth's worked on this issue, so she may have some thoughts.
No, just...
With regard to Northern Rock, it wasn't that they weren't talking with each other. The UK actually had what they call a memorandum of understanding, or a tripartite agreement between the Treasury, the Financial Services Authority, which was their regulator for all financial services. In other words, they had a single regulator for banking, securities, insurance, futures, etc., and the Bank of England. And in order to bail out a bank, you had to get all three to agree to intervene. And the Bank of England at that time, leading up to Northern Rock, kept on saying, no, we don't want to create a moral hazard problem, because if we bail them out, then everybody else will start coming. And so they waited till there was an actual run on the bank for the first time since the 1800s, and then intervened. And it was once they did intervene, it was not done particularly well, and so it didn't immediately stop the run. I somewhat am sympathetic to segregating out the ability to lend, or the monetary policy portion of the Federal Reserve's duties from its regulatory authority. Now, they argue that they need to have their hand in the pool so that they have a better feel for what's going on in the financial markets. My concern is it's too easy, if you don't get the rules right up front, to mask that you've messed up here by making lending much easier on the back end and liquidity much easier on the back end, so that you prop these people up long enough to sort them out. Unfortunately, in the most recent crisis, that didn't happen. So, I mean, actually in 2005, I wrote an article advocating for a single regulator system where the internal structure would not be, which would be much more like a Twin Peaks model, where you would have a prudential internal department, a consumer protection internal department. You would actually have an ombudsman kind of department, making certain the other two departments were actually doing what they were supposed to, and have that segregated out from the monetary function and leave the monetary function with the Federal Reserve. Now, in the wake of the crisis, people have argued, well, the UK had something like that, it didn't work. Well, the UK, after 2004, basically recreated internally the same structure that we have in the United States, where individual departments are along the lines of institutions. So they, instead of having a prudential regulator and a consumer market protection regulator, they had a banking regulator, a large banking regulator, or small banking I mean, they had individual, and it's very easy to capture those individual units. And in addition, they were heavily competitive with New York for who was going to be the world's biggest market. And as a result, as they were both competing for who could deregulate the most in order to get the most share of the market, which was kind of weird because, as Arthur's pointed out, the banks are the same on both sides of the Atlantic. All of the major investment banks in the UK are either American or German or Swiss or Japanese. There is no, within the last couple of years, the very last major investment bank that was a UK bank was bought by, I think it was JP Morgan. And as a result, they call it the Wimbledonization of the financial institution, because you have, Goldman Sachs lobbying the FSA to loosen things up, and they have them lobbying the New York regulators to loosen things up. And it's like, okay, that's great. You want us to both loosen things up. Of course, when everything went wrong, it was the national authority that had the strongest connection to them that ended up bailing them out. So Lehman, over half of its business was done outside the United States, but nobody rushed in to rescue Lehman. For the U.S. financial institutions, they all turned to the American regulators to bail them out, even though they had substantial portions of their business in the UK and elsewhere.
Thanks. Yes, back there.
Someone said that the financial advisors first caused the stock market to crash, and then they caused the housing market to crash. What do you predict will be the next market?
Oh.
What is the implication?
Well, now these, I should say, not the financial advisors, but the financial conglomerates, the big diversified institutions that spread high-risk instruments all over the world. I mean, I think the next crisis that we're now struggling with, right, is a sovereign debt crisis. So certainly Europe is teetering on the edge of a systemic crisis because, you can only issue sovereign debt to bail out your banks until nobody wants to buy your bonds anymore. And, certainly Iceland, which knew that they couldn't sell bonds, just let their banks collapse, essentially. But everybody else has tried to bail out their banks. And what's interesting is that the United States is viewed as somewhat less, likely to go bust than the EU, so we can still issue bonds. But the EU, I think it's up for grabs as to whether they can actually contain their sovereign debt crisis. I know probably Professor Frankel has some thoughts on that.
Well, not so much thoughts as a bit of information, and that's they began to impose on the managers of these sovereign banks some, surprisingly enough, fiduciary duties. The issue there is politics, which is the issue here too, yes? And when do you stop being a politician and look at how much money you owe and how much money you own? And then serve the particular institution and not all the other pressure parts. And I think they're doing it now. Yes, they are. Even the UN has organized now. They have now a list of principles, and they are pushing into some kind of having the duties to the bank itself and not to anybody around it. And I think that is what will happen.
Yeah. I'm sorry. There and then there. Yeah.
I have a background in Washington. I was in Washington during the Savings and Loan crisis and represented Resolution Trust Corporation. And I was involved in drafting prospectuses for mortgage-backed securities and describing the risks with people from Goldman and all of this stuff. And my experience is, the reason I'm in Cincinnati is that I was driven out of Washington. Being too honest and knowing too much, and being too old, I can't get work even here because the people who are controlling things are hiring out of Harvard and the places that, I mean, if I tell you the conflicts of interest in Harvard's investing, Harvard was right in Enron and right in the HUD crises. They own 10% of the HUD portfolio, which I was involved in because I also advised the Department of Housing and Urban Development. When my company was fired, and at the end of the year we were fired, they made $59 billion of adjustments against Treasury and said they could not audit their financial statements. And was that on the front page of the Wall Street Journal? No, most people don't know that. And my problem is that every single one of these things that's happened had lawyers behind it. We're all talking about how bad the investment bankers are. There is a lawyer behind every single one of these things, and there's attorney-client privilege, which people are hiding behind. And when you know too much and you want to stand up for the taxpayer and the consumers and do what's right, you cannot work. You cannot be paid a living wage and survive and have your kids safe. I'm serious about that. So as long as we keep putting our money Reserve was not part of the U.S. government, that it was privately owned. And he questioned when they said that the Depression, that the banks bailed everybody out of the Depression, and he said, who the hell do you think got us into the Depression?
Right.
And he failed American history.
Right.
Yeah.
What I'm saying is, how do we, I mean, I believe with everything all of you said, but how do we get the honesty? Because no amount of regulation is going to bring honesty
All right.
to the system.
All right, so we had a comment, and I think I'll just sum it up. I think the question is the role of the attorney, I think, is the issue, and who wants to touch that?
Well, I would just say that I did a paper on Enron or WorldCom a few years ago, and I looked at all the bankruptcy examiner reports, and I was struck by, you know, I'll just say it, how complicit the lawyers were. And what was interesting was that, you know, Arthur Andersen was destroyed by that scandal, and they did some bad things. But what I actually saw in the bankruptcy examiner reports were that in many cases, the investment bankers and the lawyers were conspiring together to mislead Arthur Andersen. They would say, oh, we're going to do it this way, you know, park these assets off the balance sheet, but they're really backed by Enron, and create these fictitious profits by sales to off-balance sheet conduits that didn't really amount to sales at all. But of course, we can't show Arthur Andersen any of this stuff, because if they saw it, they wouldn't bless it. And so, no, I think the lawyers are definitely complicit. And the question, you know, I've talked to private lawyers, and I've said, you know, look, aren't there some cases where you just say, I can't do this deal? And, you know, some of them will tell me, but if we don't do it, the law firm down the street will do it. So how can we turn this business away? But it's a serious question. I agree with you.
I want to add something. Until 1979, most lawyers were bound by a fixed price. In other words, fixed. There was you got this for that, you got this for that. In 79, the Supreme Court decided to create a market in the hope that the prices that were fixed will go down. Market is good, right? Well, the result is that in the 80s and the 90s was what the ABA called the golden age of lawyers. Lawyers don't compete, lawyers cooperate. Brokers don't compete, they also cooperate. So we must recognize that part of the market is not competition, but the opposite. And that is what you saw. That is why the person will go to the other one, or to, and this is what we have to recognize.
The other thing I would add is I mean, Professor Coffey has written, after Enron wrote a paper on lawyers as gatekeepers, and I would recommend you read that.
Yes.
And there was some attempt in the Sarbanes-Oxley Act to require lawyers to report bad actions. They refused to require, they got beaten down by the ABA for making actual affirmative duty to report to the SEC. It was voluntary, but they are required to report up the chain of command all the way up to the board of directors if they believe that there is fraud going on with financial fraud going on within the company. One of the things that struck me when I was practicing in the UK, because I practiced as an attorney for 8 years, the last 4 of which was in the UK, was the slightly different accent that they put on professional responsibility. While in professional responsibility here, there is some language in almost all state codes that you are not only a professional responsible to your client, but you are also responsible to the courts. In most professional responsibility courses, that gets severely downplayed. It's slightly more played up in the UK, in part because it's a small island. It's much more easy, particularly if you're a barrister, because those are the ones who are actually going to court. For everybody to know everybody, and so your reputation can be destroyed if you are undermining the court by shady legal tactics. But you know, one of the things that I suppose one could do if one wanted to put more emphasis on the lawyers is to put more emphasis on that aspect of professional responsibility, which at least, I don't know, when I was taking professional responsibility several decades ago, was not heavily emphasized in my class.
Unfortunately, one of my jobs here is keep the train on time, and it's time to end this panel. I know we could go on for much longer, and so let's all thank our panelists, please.